Welcome back to the Steve and Mack Show. I'm Steve,
And I'm Mack.
and we are back for a special weekly broadcast. So, Mack, what a day it has been.
Yes, it has been quite the day.
I started my day this morning, had a cup of coffee, and before I knew it, checked the Dow futures. They said we were down more than 1,000. It's kind of what I expected. But what I didn't expect was to get a message from my M1 Finance account saying that my transactions were on a brief hold due to the volatility of the market. I also logged into my Vanguard account and saw a similar message that trading was halted for the time being. And analysts were saying that basically this was almost like a circuit breaker, if you will, that halted all trading, froze transactions from happening to prevent further market downturn. It was something that most seasoned investors have not seen in a very long time. Now, it's been a rough week. If you guys have checked out our first video on the coronavirus last week, we discussed what you should do, what is our recommendation of how we would handle it, or what we're doing currently with our accounts. Um, but yes, it was quite the day today, and that's why we wanted to bring you this special message. I know it can be difficult in times like this to stay vigilant and to stay the course. I know in times like this, the first reaction may be to want to get out. But now is certainly not the time for that. I think you have to look at your holdings and try to find opportunities and continue your weekly purchases, whether it's your cost dollar average schedule or continue with some sort of strategic buying. Mac, what would you suggest for our listeners tonight when they're looking at their accounts and wondering, what am I doing? Is this going to return? What do you tell them, Mac?
Well, I think a few things I would tell them is look at the companies you're invested in. And when I started investing, as I've told you before, I did broad market mutual funds and ETFs. And it's only recently, within the last few months, that I've actually gotten into individual companies. But what I would recommend, what I'm doing is, well, I can't even really say that because when I picked the companies I wanted to invest in, I picked good companies. And so I think that's the important thing to do is at a baseline, invest in good companies. And then when you're going through times like this of extreme market volatility, and it's not even really volatile, it's just going down at this point. Volatility
Right.
usually implies, it's the roller coaster going up and down. Right now, it's just going down. But look at your companies that you're invested in and ask yourself what you think the long term prognosis is for the companies you're invested in. And if you're like me and probably like Steven, I think the conclusion I've come to is that I'm invested in good companies, and I have no fear of any long-term downturns based on whatever it is we're going through right now, whether it's coronavirus, the trade war before that. It's always something that somebody's rumors and murmurs, it's always something that is supposed to spell the end of, um, capitalism, I guess. But you look at your companies and say, is McDonald's going to go out of business because of coronavirus? Is Coca-Cola going to go out of business? Is Waste Management going to go out of business because of coronavirus? Is Home Depot, Walmart, Target, Intel, Apple, are these companies going to go out of business because of coronavirus? And I think if you're a reasonable person, the answer to that should probably be no. Um, and so me personally, I just ask myself, what reason do I have to sell if I have faith in these companies? Um, I'm very big on planning. You always need to have a plan, and so if you plan accordingly and you plan well, these are the times when the plan that you've laid out gets tested. And so the great American heavyweight Mike Tyson had a great saying. Uh, everyone has a plan until they get hit in the face. And a lot of people, a lot of boxers would probably come to the ring to fight Mike Tyson with a plan. They got hit in the face, and their plans went out the window. And so now's the time to see the markets hitting us in the face. And are you going to be uh, Michael Spinks or Peter McNeely or one of these other low tier boxers that Mike Tyson went and just ran through? Or are you going to be Vander Holyfield, Lennox Lewis, the boxers that stood up, looked the bully in the face, and said, "Hey, let's go at it." And so I have to just be honest. Personally, I've really been waiting for this moment since I started investing. Since I started investing, and probably you could probably say the same for yourself, we've had it very easy. Most people who got into investing after 2009, within the last 10 years or whatever, everybody's had it easy. Everybody's been a genius investor for the last 10 or 11 years, and now is the time where you get to see what you're really made of, you know. So really what I would just advise is what I'm doing is the same thing that I'm doing is make sure that you plan well for moments like this so that you aren't now looking and running scared.
I couldn't have said that better myself, and I completely agree with that. We really must stare this down and with confidence be able to look at our portfolio and say that we have chosen quality companies. As you said before, do you think a Walmart, Costco, McDonald's, and in our case, I know we're both invested in a lot of ETF or basket of stocks. Do we really think that there's a major threat to the future of these companies? And the answer, I would say, in my opinion, is no. Obviously, we've entered now what they're considering the beginning stages of a bear market, where the market's down 20% from the all-time high. And we've been discussing for the past few weeks what could happen if this was something that was posed as a threat. And I think now people are going to be tested. Investors are going to be tested, see whether or not they have stamina for this kind of market. So at this point, it's really, you got to look at your holdings and say, I've made a good choice, and now I'm going to continue onward, whether it's my cost dollar averaging or trying to find opportunities in the market. I know right now it's difficult to find places to hide out in the market. To give an example, today, some of you may hold oil stocks or energy stocks, and ExxonMobil is down 13% today. Marathon Oil was down 46% today, to give a bird's eye view of some of those heavy hit stocks in the market right now. Industrials were hit hard. Caterpillar down 14%. 3M is down. Leggett & Platt is down. So there isn't many places to hide out. REITs are down. Apple Realty Corp down 11% today. So in times like this, there really isn't a place to hide out unless you're in bonds, unless you're in a hedge like gold. There really isn't many places to hide out. So you have to be vigilant and stay with the course. If you're getting out of the market at times like this, you're really going to get eaten alive. So you really want to stay in and stay confident. The only thing right now, try to manage your cash fund if you have cash on the sidelines. Try to keep that strong because you don't know how long this is going to last. But what we know and what we try to deliver in our messages is the fact that we believe that this is being driven due to uncertainty in the markets. But we certainly know that from experience in the stock market and looking at charts and knowing the history of the market going back 100 years, that the market will indeed bounce back.
So, yeah, very good, all very good points. Just something else I'd like to tack on alongside what you said is I think I've probably alluded to the point in every video we've made so far is that my basic overall financial philosophy is based on the teachings of the financial coach Dave Ramsey. And so, as I said, I think the last video, probably the video before that, his big thing is get out of debt, focus on getting out of debt. And so, in various, whether it's on Facebook or Twitter or various places, you'll always hear people ask the question, why would I pay off my debt when I can make 7%, 8%, 9% in the markets? And today and last week, what's today? Monday?
Today's Monday.
Today's Monday.
Murder
Okay.
Monday or
Murder
Bloody
Monday, Black Monday,
Monday.
Bloody Monday. Yes, yes. All of that. Last week, the week before that. Those are the reasons why. Because you don't always know for sure that you're going to get that. If honestly, are you confident we're going to get 7% returns by the end of the year?
I'm absolutely not confident. I'm planning on. I'd be lucky if I get 7% returns back 2 years from now.
Exactly. My M1 portfolio is currently down 21%,
I'm
21,
right there.
almost
I'm right there
22%.
with you. Right there with you.
So, this is kind of the trap you run into being a millennial or Generation Z investor where you've only invested in good times, and you kind of stumble into this idea that you're maybe, just 7% returns are just a fact of life. The S&P, I think, was up close to 30% last year. And so it's always manna from heaven as far as you're concerned, as far as investing goes. And I think we'll be extremely lucky to even break even. Who knows? Like we said in the last video, who knows how much longer this will last? So when you look at your portfolio and you're down 21%, that's the reason that me personally, I do believe it's very important to get out of debt outside of maybe your home. Clearly you don't want to wait to invest before you don't want to say I'm not going to invest until I get my home paid off. But everything else, vehicle debt, credit card debt, that stuff really needs to be out of the way, because if you're banking on getting a 7 or 8% return and you end up down 20, 25, 30% for the year, that basically has blown your entire plan out the window. And it's kind of like, where do you go from there?
No, absolutely right. You're absolutely right with that. I did some strategic buying today. I saw some opportunities in the market, but you have to know what's your risk tolerance. I know that these purchases I made today could very well drop tomorrow 10 more percent. I'm prepared for that.
Right.
I'm
Right.
prepared for that. We talked about a couple of months ago. How would it be like to wake up and see your portfolio drop by 50%? We joked, we laughed about that, but the reality is that could be the reality, right?
Yeah, absolutely.
So it's something you got to prepare for. And there's no place I'd rather be, because this is something you got to experience. You got to be able to say, I was in the market in 2019, 2020. I was in the
And
market.
I looked the bear in the face to face, and I stared him down, and I didn't back down.
Absolutely. Absolutely. And is it great getting into the market and seeing nothing but gains every week as a newer investor? Yeah, it was wonderful. I can say that. It was very nice. But this is the reality of it. And this is what's going to set apart those who get into the market and stay in the market through retirement, and those who get into the market and say, oh, I used to be in the market back in 2020, but I got out and I never got back in.
And the position you're going to be in at that point is the same place where people who looked at what happened in 2008 and decided, that the market investing wasn't for them based on that, and ended up, you end up, I guess, you just put your money in a Bank of America savings account, or maybe a high yield one at best, where you're making 1.5%. But most people aren't even doing that. Most people are in your Wells Fargo's and your Bank of America's, Capital One basic savings account, where you're making 0.5%, if that. And because of these dips, these blips on the radar, they scare a lot of people off from long-term investing, or people who are investing, they get out because of these events and end up never getting back in. And you end up missing out on great opportunities to see your money grow almost exponentially.
Absolutely. I talked to a guy today. He said, see the market. He said he saw CNN. He said, this is the reason why I don't invest. This is the reason I don't invest. So people see this once every, this is not normal, what's happening right now. Okay? This is the most volatility in the market since 2008, 2009.
Mm-hmm.
So this is not normal, but you got to be prepared for it. In the long history of the stock market, there's been a lot of ups and downs. So he said, well, this is the reason I don't invest. Well, if that's the mentality you have, then exactly as Max said, you're going to be the type of person perhaps that will put their money in a Wells Fargo or Bank of America saving account earning 0.05% on your money, or if you're lucky, maybe a money market earning 1 or 2%, but you're certainly not going to be taking part in 20% gains like we had in 2019. Now, granted, a lot of those have been erased, but the point is that if you're going to be a very cautious investor, or a cautious person rather, you're not going to be able to take advantage of the potential the stock market has to offer.
And what you should have done when your friend or colleague, acquaintance, whoever it was, when he brought up the days like today, is you should have shown him the long-term history of the Dow or the S&P, NASDAQ, whatever the case may be. And you'll see on there some very violent dips throughout time. You know, I'm looking now, we had looks like we had a pretty considerable dip around 57, 58. 1960s, we had a good dip. You know, then 87, of course, and then 2001, 2002, and then 2008. But if you look, the entire time, the market's trending up, but it doesn't go up in a straight line. The market trends up, but it goes up and down as it's trending up. So all you would have to do would be to show your friend the chart and say, hey, you know, if you had started out with $1,000, if you started out with say $1,000 and you had put it in the market, say in 1980, you'd have, just hypothetically, that $1,000 would be $50,000 today. And now maybe at some point it would have gone down to $800. Then it would have went up to, you know, 1,100, and then down up to 1,500, down a little bit, up to 2,000, down a little bit. But that's just the nature of the market. And, you know, days like today, the last week, the last maybe probably month we've had, that's just that's the price you have to pay for the long-term gains, you know, that you're going to get from the market. It's not always going to be just a smooth ascent to the top. It's going to be a bumpy road, but the bumpy road takes you to some very good places.
No, you're absolutely right. It's really, the market has a way of weeding out the weak. And I think Warren Buffett had a quote about that if you can't stomach seeing your investments drop, then you shouldn't be in the market at all. You should be that money market person. You should be that person who holds paper bonds or some other very low risk type investment vehicle. But you probably shouldn't be an investor in the stock market. So you have to just stay the course, trust in your investments, and know when to make adjustments with your holdings.
Absolutely.
Absolutely.
I think that's going to about wrap it up, unless you have anything else to add.
I just want to take this opportunity to mention that we are both founders of the Layman Financials, a Journey to Wealth group on Facebook. If you haven't had a moment yet, definitely check us out there. We're trying to walk along this journey to wealth. We know it doesn't happen overnight. We know it's a long journey, and we're just trying to provide content and allow others to provide their own content that can help motivate people to get to the level that they desire. So check us out on the Layman Financials, a Journey to Wealth Facebook page. And with that message, we'll be signing off. This is Steve T with Layman Financials.
And this is Mack G with Layman Financials.
Peace.
Peace.